Market trends show signs of an upcoming global recession, and everyone is afraid of a repeat of the Great Depression. In an interview earlier this year, Peter Schiff explained the inner workings of this financial crisis and how significant its impact may be. Join us in today's video as we hear Peter Schiff's analysis of this dire situation.
Well, I think another financial crisis is inevitable. What's not inevitable is the nature of the crisis. It could be very different than 2008, and I think it will be different. I think it will also be a lot worse. But at this point, I don't know whether it's stocks that are going to crash and real estate that's going to crash, or if it's going to be the dollar that's going to crash. Because if the dollar crashes, it won't look like stocks are crashing or real estate is crashing, but the crash will be happening behind the scenes, and it will be easy to measure it in terms of gold. Because if we get a collapse in the value of the dollar, the price of gold will go up dramatically, and it will go up much more than the price of stocks or real estate. So in terms of real money, there's definitely going to be a crash. But in terms of fiat money, it's hard to say, because we could have runaway inflation.
Steve, over to you. Why do you think a crash might be likely?
When you look at the stock market, you have to look at margin debt, and the level of margin debt is now the second highest it's been in history. The highest in history was 1929, and it fell from 13% of GDP to 0.5% in that crash. It's now running at 3%, 3 to 4%, which is, not, believe it or not, the highest since then. But that's if it wasn't for the Fed, then I think we would see a stock market crash. So long as the Fed continues with QE and continues buying assets off the non-bank financial sector, then they could, in any bust that occurs, they could reinflate, which is what they've been doing since 2009.
We know how artificially inflated central banks have kept financial markets over, if we went back the last 15 years to the financial crisis. What do you think is the trigger that is going to kick off a crash?
Well, these days it's actually physical triggers, breakdown of the global supply chain, and this is something which has never happened before. And it's after 40 years of American corporations in particular outsourcing production to third world countries, primarily China, and producing a deflation above and beyond what would have happened if you had industry staying back in America. And now that's being unwound because of COVID, because of crises from global warming and so on. When you start bringing those goods back on shore, you're necessarily going to have an increase in the cost of supply.
We've been able to export our inflation. We run these enormous trade deficits, so we print all this money, but then we send the money to China, and China sends us products. So we get goods to consume that we didn't produce, and the money is sent to China, and that gets recirculated into U.S. financial assets, keeping our interest rates down, keeping our stock prices up. And so that's how we've been able to manage to create all this inflation, but maintain, a smaller increase in our cost of living. But now that all that's breaking down, and if America is going to have to start producing more domestically and deal with the domestic cost structure, prices are going to go through the roof if we can no longer import the stuff that we consume, and if we can't pay for it by exporting our money. If the money we print gets trapped in the US, if it stays here bidding up prices go ballistic. And the reason the Fed was able to maintain all this stimulus, to do all the QE, they hid behind that veneer of low inflation. There is no more basis that the Fed can hide behind to justify continuing this policy. And so if they have to withdraw it, then everything that was built on top of it will collapse.
If we take a step back and look at perhaps how recent history has affected how we got here, if we look back over the last couple of years, the pandemic fundamentally changed the way that governments ran their economies. Do you think that the global health crisis and the government fiscal policies like stimulus, like furlough, have played a role in boosting things up and paving the way for a crash?
Well, there would have been a crash with coronavirus if there hadn't been government spending, because you can't pay your debts when you haven't got any cash flow. That means a complete crash in the cash flow of a market economy. Now, in that situation, the only group that can create money and enable people to pay their bills and so on is the government. And the government creates money by running a deficit. Like banks create money by lending more than they get back in repayments. Governments do it by running a deficit. You had an enormous deficit in every country in the world, pretty much. I think America's was over 20% of GDP. Now, if that hadn't been there, the private sector would have crashed even further, because you couldn't have paid your debts, you would have gone bankrupt, the bank would have failed, etc., etc. That chain reaction would have been there. So the government spending was essential to avoid that chain reaction.
I think the problem that was really exposed by COVID was the problems created by governments and central banks, where there is inadequate savings, where too many people are living off of debt. Had we had the type of economy that we had, let's say, going into the Second World War, where we had a much bigger crisis than COVID, and Americans really tightened their belts, taxes on the middle class skyrocketed, goods and services were rationed, the US government borrowed tons of money from middle-class Americans by selling them war bonds. But when COVID hit, nobody had any savings. Everybody was loaded up with debt. Nobody could stay home from work for a month. Nobody had reserves to pay the rent, to pay their bills. If you lost a paycheck, you couldn't pay anything. And we had this entire house of cards created by the government and the Federal Reserve, where we had nothing saved for a rainy day. I think we're going to be worse off because of what the government did, because they printed all this money so we can keep spending it. But what the government didn't replace was the lost productivity. They can print all the money they want, but if people aren't working, if they're not producing goods and they're not producing services, the money they're printing has no value. And all that happens is prices go up. And we're just at the tip of that iceberg.
I'll go back a bit and I'll talk about the war bonds, which Peter was saying finance government spending. When you do the accounting, and this is not economics, this is strict accounting, when you look at what war bonds do, they actually take money out of the hands of the private sector. They don't finance the war. The war is financed by running a deficit, and this is all through accounting. The government is a money creator. It creates money by running a deficit. It doesn't need to borrow like you and I do in a household, or a firm needs to do. So that is the big difference. And then when it's created...
During the Second World War, we were on the gold standard back then, so they couldn't just create gold.
No, they can't create gold, I agree, but they can create fiat money, and that's what we did.
Yeah, but whenever they create fiat money, they destroy the value of the money that already exists. They don't add any value to the economy by printing more money. They just cause us to have to reprice everything. So the more money they print, the more expensive everything becomes. Nobody gets richer because you increase the quantity of money. You only get richer if you increase the quantity of stuff.
The S&P at the time of recording this is down around about 9% for the year. So, as expert observers of the markets, if I come to you first, Peter, what might you and others do to try and shield yourself from the worst outcomes of a potential financial crash?
Well, I think when it comes to investing, I think 2021 represented the actual peak of the speculative mania, where investors threw all reason and caution to the wind and just piled into anything that was going up. I mean, because you had the popularity of meme stock investing, you had Cathie Wood with her innovation ETF, you had NFTs and cryptocurrencies. I mean, you name it, as long as it was going up, people bought it. And there was no limit to how high a price people were willing to pay to jump on a bandwagon. I think you're going to see a much bigger investment in real things as opposed to fake things or digital or fantasy, into real things, real industrial metals or agricultural commodities or energy. Real stuff is going to come into vogue again.
Okay, well, the first thing is that quantitative easing, so long as the Fed continues doing it and there's no limit to its capacity to do it, that will continue reinflating the stock market after crashes. So I still see that being a potential strategy. But I agree with you on commodities and hard objects. We are actually very, very close to running out of a large number of essential minerals. Crazily enough, one of them is phosphorus. And without that, you and I, if you forget about having a pulse. You don't have phosphate, you don't have a life. So we're even running low, can be running close on that. Lithium itself is in relatively low supply. There's a whole range of minerals which are essential for what you might call a post-oil minerals-based economy rather than fossil fuel-based economy, and they're all running in short supply. So yes, I think it's going to be commodity plays that make more sense in the future, but don't bet against the capacity of the Fed to reinflate the stock market because it has unlimited capacity to finance that.
In the past, the Federal Reserve was able to get away with QE programs because it could point to a CPI that was below 2%, and that was the justification for the policy. But what happens if we get a stock market crash and inflation is 8% or 10%? What if it's inflation that is the reason the market is crashing? It's hard to imagine the Fed coming to the rescue of the market by creating even more inflation when inflation is the reason the market is crashing. And maybe the bond market is crashing because of inflation. And so if the Fed creates even more inflation to prop up the stock market, that's going to be an even bigger drag on the bond market. So it's a very difficult situation now that the Fed is in, because the only way the Fed could do another round of QE in a world of high inflation is if it's willing to accept even more inflation. In fact, it has to be willing to potentially unleash hyperinflation.
So Peter, hyperinflation, what does that look like if we did have that?
That's terrible. I mean, hyperinflation is basically the death of a fiat currency. It just means that the money is losing value so fast. We're not talking about 10% inflation a year, or maybe not even 10% a month, but maybe 10% a week, or even a day, because nobody has any confidence in the currency. And so the minute you get it, you want to get rid of it, right? The velocity just explodes because currency becomes like a hot potato.
Steve, over to you. We know inflation is at a 4-decade high in the States. The Fed is forecasting inflation dropping to 4% by the end of the year. Are you worried about the prospect of hyperinflation or even much higher inflation than we have now?
No, I'm not. I think we're going to have sustained inflation from the supply side, and that's what's different to any previous crisis. Now, the Fed's tools are all directed at reducing demand-driven inflation. When you put interest rates up, you make it harder to finance your debts, and you therefore cause a downturn in demand, and that downturn in demand causes inflation to fall. That's what happened under Volcker. This time round, it's actually the cost of producing stuff going up, and the only way you can actually reduce that inflation is to have firms charge a lower margin, which they're not likely to do. So I think we're going to see a form of inflation the Fed can't fight. Now, the real thing we should do is reconstruct domestic manufacturing. And that is also not just over COVID, but also over climate change. That's going to be a necessity. That'll necessarily mean higher prices. It'll mean, but you have to be careful in that situation. You can't have prices so high that the working class can't afford to eat.
You got the cart before the horse. I think it's inflation that causes costs to rise. Now, within an economy, the cost of some goods could go up to produce. But if that happens, then it's going to divert demand away from other goods and services that people can no longer afford because certain goods are more expensive. So the overall price level won't go up. What enables all prices to go up is the government printing more money. Inflation is always about money creation. So the only way you have this excess demand that exceeds what you are capable of producing is if the government supplies it with money. And then the way the market corrects that is just repricing everything higher. And then we call that inflation. But the cause of it and the real definition, and if you go back to an old Webster's dictionary and you actually look up inflation in an old dictionary, it will define it as an expansion of the supply of money. That's what the word literally means. But going back to the Great Depression, the reason that nobody knows about the Great Depression of 1920 is because it was over very quickly, because the government did cut spending in 1920 when that downturn began, when that stock market collapse began, and the Depression ended very quickly. If we could go back to the free market capitalism that built this country in the 19th century, instead of the government socialism that destroyed it in the 20th and the 21st, we would have a much more vibrant economy that had a much higher standard of living for average Americans.
What did you think of Peter Schiff's point of view? How bad do you believe this crisis is going to be? Give us your insights in the comment section down below. If you enjoyed this video, kindly like and subscribe, and we'll see you on the next one.